Where are you, my boy? Are you in the wash basket? Are you in the cupboard? Or are you behind the bush in the garden, under the bed, or somewhere in the garden? As we go through this accounting lesson, let's see if we can find where Caleb is hiding. In this lesson, I'm going to look at transactions, and we're going to record these transactions on T accounts by applying our accounting rules. Just a little bit of revision. What is a T account before we record transactions on T accounts? In the general ledger will have all the accounts listed inside the ledger. So for example, here we have the capital account, the owner's account, and the general ledger is divided into a left-hand side and a right-hand side. Their column headings: date, details, folio, amount, and that is on the left-hand side, which is the debit side. DR comes from the Latin word debitore, that's why it's abbreviated DR. And on the right-hand side we have the credit side, from the Latin word creditor. Now you see, every single ledger account is divided into two sides, and this here, if I divide the two sides in half, it forms a T, and that is where the phrase or term comes from, T accounts. And you will use T accounts in your workings. Your lecturer can use T accounts to explain work. So T accounts, even though it's not a formal way of doing things, they're used in accounting regularly. So we are going to do transactions on T accounts. Now you know what a T account is and where the term T account comes from. We are going to record these transactions of Calibu Education for January on T accounts. So there are 8 transactions just to demonstrate how to record these accounts on T accounts in case you're asked to do transactions in this way in your exam or test. So all these transactions, we're going to debit and credit accounts that are affected by the transactions, and we're going to demonstrate which accounts are debited and credited on T accounts. I will go through each of these 8 transactions individually. We're going to apply the rules, and we're going to solve each transaction by debiting one account and crediting another account. We're going to apply the rules, the accounting rules, to debit and credit the correct general ledger accounts. I wonder if Caleb is under the bed, somewhere underneath there. We'll have to check a little bit later. This is the first transaction. Richard, the owner of Calibu Education, contributed his vehicle to the business. The value of the vehicle was $120,000. An owner can contribute cash or an asset to the business, or anything to the business. Now let's follow the steps here. We've read the transaction. We need to identify the accounts involved. And the first account is vehicles. The second account, when an owner makes a contribution, the owner's account is capital. So now what I need to do is I need to classify the accounts. Okay, by definition, we know vehicles is an asset. Now on the business's books, the vehicles asset account, the asset account vehicles, the value of the vehicles has increased. And the rule says an increase in the value of an asset, the account must be debited. Let's have a look at capital here. Capital is its own category. The capital, according to the business's books, the owner has become worth more because of this capital contribution, the contribution of a vehicle. So capital has increased, the account will be credited according to our rules. So the vehicles account, an increase in assets is debited. Underneath the debit side of vehicles, we will write the name of the other account, the contra account, which is capital, and then obviously the amount. So vehicles was debited. Why? Because I used the arrow. An increase in the value of assets, the rule says we must debit that account. Then there was an increase in capital, and the rule says the account must be credited. So underneath capital, on the credit side, vehicles will appear under details, and the amount is 120,000. So capital was credited and vehicles was debited according to our rules. There we go, we applied the rules. So we got just steps to deal with the transaction, and I have the rules here. If I rub this all out, you can see the answer clearly. If you hear that siren, I live in a country where you hear the siren quite often. Right, so there's the answer. We have the transaction, we read the transaction, we identified the two accounts. Vehicles, according to the rules, got debited. Capital, according to the rules, got credited. Underneath the vehicles on the debit side will appear the name of the other account. So it's the contra account, which is capital. And under capital, on the credit side, in the details column will appear vehicles, the name of the contra account to capital, the other account. So under details, a cross-reference is formed between these two accounts by filling in the contra account, and there's a cross-reference. Right, so that's the first transaction. Richard, the owner of Calibu Education, contributed a vehicle to the business. And we've recorded these items, these transactions, or this transaction, in T accounts. I wonder if Caleb is in the cupboard. We'll have to check a little bit later. But in the meantime, let's carry on with accounting. Transaction number 2. Calibu Education paid cash for advertising in order to promote their latest video, 1,300. So we've read the transaction. We need to identify the accounts involved. Whenever there is cash being paid, the one account will always be bank, and in this case here, we're paying for advertising. So the one account will be advertising, And advertising by definition is an expense. The advertising cost has increased. So when there's an increase in an expense, the account is debited according to our rules. But first, let's just have a look. As I mentioned, if cash is involved, the one account will always be bank. Bank, if it has a positive balance, is an asset. If we're paying cash for advertising, the bank balance will decrease, so the value of the asset has decreased, and the rule says the account must be credited. So advertising, because it's an increase in expense, it is debited according to the rule which I just showed you. So on the debit side of advertising, we will have the name of the contra account and the amount. So on the left hand side of this T account, the debit side, we put in the entry bank 1,300. Then the credit entry, because bank is an asset and there's a decrease, this arrow is pointing downwards, in the bank balance, the account gets credited as per our rules. A decrease in assets, the account gets credited. The name of the contra account is written under, if we had the column headings here, there would be a column heading for details. We write the name of the contra account, advertising, and the amount is 1,300. So if I just show you the finished T account entries, advertising was debited and bank was credited. And Caleb, he could be in the cupboard. We'll have to, as we go along, just check if he's going to jump out of the cupboard or not. So advertising was debited and bank was credited. Remember, the name of the contra accounts appear in the ledger account. So say for example, bank got credited and the other side of the entry is advertising. It appears on the credit side of bank. And the same in advertising, under the column, if the heading was there, details, the name of the contra account, bank. So anyway, advertising was debited and bank was credited according to our rules, and we followed these steps here to get to this answer.
You can't find me.
Yeah, we will find you, boy. In time we will find you. So let's have a look at this next transaction. It says transactions of Calibre Education. Right, rent received for the month of January, 3,500. So Calibre Education rents out some of its office space, and 3,500 has been received for the month of January. So we follow these steps once again. Steps to deal with a transaction, we've read it. Identify the accounts involved. The money was received. We need to see if it's an asset, an expense, income, and we need to apply the rules. So we read the transaction, identify the accounts involved, and here we have rent received, and the other account is bank. What are you going to do with the rent that you receive? It's going to go into your bank account. Now what we need to do is we need to classify these accounts. Rent received, by definition, is income, and rent received has increased, so the account will be credited. Bank is an asset. Calibu Education's bank account has increased, the account will be debited. So rent received, because it's income, and income has increased, it will be credited. Bank will be debited, increase in assets. As you can see, I always apply the rules. There's nothing you can learn here except for the rules. Once you know the rules, you apply the rules, and then you will understand why an account is debited and why an account is credited. So rent received, increase in income, the rule says credit. Under the details column, you're going to have the name of the contra account, which is bank, and the amount is 3,500. Rent received was credited because I applied the rule, increase in income, the rule says credit the account. And there we go. You go and put the entry on the right hand side of the T account, which is the credit side. Then the account that is debited is bank, and why? Because the bank balance has increased, that's an A. Increase in assets, the rule says the account must be debited. Under details in the column, we're going to write the name of the contra account, which is rent received, and the amount is 3,500. And there we go. There's the copy or the answer without the scribbles. So this transaction here, rent received, one account's rent received, the other account is bank. Rent received is credited, bank is debited according to the rules. There we go. You can't go wrong. If you know these rules and you can classify these accounts correctly, you cannot go wrong. You must go check out my video on the rules. I'm not sure. We're going to have to check and see if you're in the garden. But before we get to come see if you're hiding in the garden, we need to do transaction number 4. So Calibu Education has made a sale of stock. The selling price is 3,000, and the stock that is being sold for 3,000 was purchased for 1,000. This is a cash sale, so the one account when cash is involved will always be bank. So by now you know we apply these steps to deal with the transaction. We've read the transaction, we identify the accounts, and I just mentioned because it's cash, the one account will be bank. And there are 2 parts to this transaction. We need to record the sale, and we need to record the cost of sale. So let's have a look at how we're going to deal with this in our T accounts. So we identified the accounts involved. Cash, one account is bank, and the other account when we record a sale is sales. Now what we need to do is we need to classify these accounts. Bank is an asset. This was a cash sale, so our asset value, our bank balance has increased by 3,000. And if we look, bank is an asset. The rule says when there's an increase in the value of an asset, the account must be debited. And while we've got sales up there, sales is income. And if we go to the rule, income. Our income has increased, the account is going to be credited. So bank gets debited, an increase in assets. Under details, we write the name of the contra account, the other account affected by the sale. So in the bank account, and the other account is sales, and the amount is 3,000. So bank was debited, and sales is credited. The entry goes on the credit side, and the name of the other account is written under details. The other account, in this case, while we're looking at the sales account, is bank, and the amount is 3,000. So this here I would call part A of the transaction, record the sale. And the two accounts in a cash sale, when we record the sale, are bank and sales. But now there's a part B to this transaction. We need to record the cost of sales. We're using the perpetual inventory system, which means we can calculate the value of our stock on hand, what we should have on hand, after every single sale of stock. So part B for this transaction here is to record the cost of the sale. When we make a sale, the trading inventory is what some textbooks would say expensed, to show the expense of the cost of the sale. The cost of the sale. Right, we're not making a 3,000 profit here. There was a cost. And the cost here was the price we paid for the stock that we got from the printers. So we open up an account now called cost of sales. And cost of sales is an expense. The expense at the point of sale has increased. And the rule says an increase in expense, the account must be debited. The other account is trading inventory for part B of this transaction. Trading inventory is an asset. Now the trading inventory value on our books has decreased because the trading inventory has been given to the customer. So now we can't show trading inventory as an asset anymore because the value of the trading inventory has decreased by the cost of the stock that is being sold, 1,000. So cost of sales is debited. Why? Because the rule says if there's an increase in expense, we need to debit that account. So on the debit side of cost of sales, under details, the contra account, trading inventory, and the cost of the stock we have sold was 1,000. Trading inventory, the balance of our trading inventory has decreased by 1,000. That stock has been given to the customer. We can't show that stock on our books anymore as it has left the building. And the contra account to trading inventory in this case is cost of sales. So cost of sales was debited and trading inventory was credited. We applied our rules. Cost of sales, increase in expense. Trading inventory, decrease in assets. At the cost price of the goods being sold. So let me rub this all out and I will just explain this again. This is a more challenging transaction. All the others only had 2 accounts involved. This transaction, when a sale is made, there are 4 accounts involved and there are 2 parts to the sale. Part A, record the sale, and there it is. This was a cash sale, So the account that was debited was bank. Sales was credited. Then there's part B, cost of sales got debited, and trading inventory got credited. Now, this is quite interesting because after every sale, or if we only had this one sale, we could calculate the gross profit. Gross profit is calculated by income from sales minus expenses, the expense from the sale. Sales minus cost of sales. Sales minus cost of sales will give you the gross profit. 3,000 minus 1,000 is equal to 2,000. Obviously, I'm only looking at one sale here, but there would be hundreds of sales, hopefully, and you're able to calculate the gross profit quite easily because you know the cost price of the stock that you are selling. It's given here. So we'll concentrate more on this transaction in future videos, but just to introduce you to a sale in T accounts, this slide will help you tremendously in understanding a sale. Obviously, we can have a credit sale as well. I will do one in future videos so you can see how to deal with a credit sale, which accounts are debited and which accounts are credited.
On the roof.
Don't worry, my boy, we will find you. I'm going to come check if you're in the bush on the roof. We will find you. Right, this brings us to transaction number 5. Received a loan from the bank, 10,000. So the money that the owner, Richard, put in might not have been enough, and an extra 10,000 needed to be lent from the bank. So we follow the steps. We read the transaction, identify the accounts. If we receive a loan from the bank, the money will be put into the business bank account. And bank, in this case, positive bank balance, is an asset. 10,000 Rand, or 10,000, whatever currency you're using, is going to be put into the business bank account. Bank is an asset. The bank balance is going to increase. The account will be debited according to the rules. But now we have a loan, and the name of the bank is, I've just made it, the bank. So we have a loan with the bank. It's important to put the name of the institution that you have a loan with. So loan, the bank is the name of the account. Now a loan is a liability, and the liability has increased because this 10,000 is going to have to be paid back over an agreed upon time to the bank with interest. But what we're recording with this transaction is just receipt of the loan. The business is getting the loan. How do we record it? It's day one. So let's see how it is recorded. The two accounts involved, bank and the loan with the bank. So bank was an asset, is an asset, and it gets debited because our bank balance has increased when the 10,000 hits our bank account, the business bank account. The name of the contra account to bank in this transaction is loan, the bank, and the account gets debited. Why? Increase in assets. But what happened to the account loan, the bank? It got credited because it was an increase in liabilities. And under details, you're going to have the name of the contra account to loan the bank, which is just the bank account of the business, and the amount is 10,000. So bank was debited, and loan was credited. By now, on the 5th transaction, you should be getting the hang of recording transactions in T accounts. Remember, this is not a formal way of recording transactions, but it can be a exam type question, a test type question, because the examiner might want to just check 10 transactions. Can you debit and credit accounts? Can you apply the rules? Do you know the steps to deal with transactions? The important thing is knowing your rules and being able to classify your accounts. Is an account an asset? Is it drawings, capital? Is it a liability? Is it income? Is it an expense? And then you apply the rules, and you will know which account to debit and which account to credit. But like anything, it takes practice. I wonder if Caleb could be in the fridge or the cupboard. We will check. We will find him. Interest received on the positive bank balance, 550. So what happened here was we have a positive bank balance. We are earning interest, and 550 interest is earned. We've read the transaction. We identify the accounts. What will happen with the interest that we've earned? Where is it going to be put? It will be put into our business bank account. And what did we earn? We earned interest on current account. So the two accounts involved, bank, okay, and we're going to call this account interest received. You might call it interest on current account, interest on savings account, depends what type of bank account you have. Now the bank balance, bank is an asset, the bank balance will increase by 550. Interest received is income to the business. The income has increased by 550, and the rule says credit the income account, which is interest received. So under bank, under details, you got the name of the contra account, interest received. That amount should say 550. So there's a typo. And that amount there should say 500. But in the interest received account, we have an increase in income. The account must be credited. Under details, you write the name of the contra account, which is bank, and the amount is 550. Should be 550 because the transaction reads that the interest earned is 550. It's easy to make careless mistakes, which will result in your books not balancing. So it's important to record transactions accurately. As a bookkeeper, you need to do things properly and accurately. Otherwise, you're going to have to go back and check all the transactions. Quite interestingly though, your trial balance, which we'll deal with later, because you got a 500 debit and a 500 credit, will still balance. Your debits equal your credits, but the transaction wasn't recorded properly. So there could be a problem when you do something called a bank reconciliation. You can watch a video on that. But for now, we're just recording these transactions in T accounts. Bank was debited and interest received was credited. And Caleb, we need to find him. Is Caleb behind the door? Sometimes he hides behind the door. He's not the best hider, but he's only 3, so he's trying. Now, transaction number 7. The school a client of Calibu Education, paid Calibu Education the outstanding amount on their account. So a sale was made to the school, and therefore the school is a debtor of Calibu Education, and they have an account with Calibu Education. Now they're paying the 12,300 that was outstanding. So we've read the transaction, identify the accounts involved. We are receiving 12,300. Where is that money going to be deposited? In our bank account. And what is bank? Bank is an asset. The bank balance will increase. An increase in assets, you must debit this account. The other account, and I'm only looking here at the general ledger accounts. I'm not going to go into, in this video, the individual account of the debtor, which is the school. Calibu Education has sold to the school. We're looking at general ledger accounts. And in the general ledger account, we will have accounts receivable. Some of you people might call it accounts receivable, or you might call it debtors control. I'm looking at the general ledger accounts in this exercise. Debtors control. Now it doesn't matter if you call it debtors control or accounts receivable, because a debtor, someone that we've sold to on credit, is an asset. Accounts receivable is an asset. Now what has happened is the bank balance increased, so the account bank will be debited. But on the other hand, the debtors, this debtor, the school, owes less. It's a decrease in assets, and the rule says credit. So bank was debited because the bank balance increased by 12,300. Debtors control was credited because the debtors owed 12,300 less. Our asset debtors has decreased by 12,300. Then under details, you got the contra accounts of the transaction, which actually the details links these two accounts. If I looked at the bank account only and I wanted to see the other entry of this transaction, I know I can go to the accounts receivable account and I will see it was credited. So there you go. There's transaction number 7. Received a payment from a debtor. Bank was debited and accounts receivable was credited. In other videos, there will be a debtors ledger. And the debtors ledger will have all the individual debtors in the ledger. For example, the school, which is a debtor, someone that Calibu Education sells to on credit. But we're only looking at, with this exercise or this video, the general ledger accounts. The debtors ledger is a separate video on its own. Caleb loves this wash basket to hide in. I wonder if he's in there. Transaction number 8. Calibu Education paid the computer store 800 in part payment of the amount owing. Now Calibu Education buys from the computer store. So Calibu Education has a supplier called the computer store, and Calibu Education has an account with the computer store. And this transaction says we're paying 800 as part of what we owe the computer store. Now remember, in this video I'm looking at general ledger accounts. So I've read the transaction, identify the accounts. If a payment is made, the money is going to come out the business bank account. That will be one account. Now if I have a supplier with whom I have an account, they will fall under accounts payable or credit control. So let's have a look here. When a payment is made, the business bank account will decrease. The bank account of the business is an asset. A decrease in assets, the account gets credited. Who are we paying? A creditor. So the name of the account is accounts payable or creditors control, but it doesn't matter what you call it, as long as you classify accounts payable as a liability. Now what has happened is, when we make a payment to a creditor, a supplier with whom we have an account, the amount of money that we owe them decreases. And the rule says a decrease in liability must be debited. So what happened to our bank balance? It decreased. A decrease in asset, the rule says credit the account. And the details, accounts payable, the name of the contra account. The amount was 800. Then what happens to accounts payable or creditors control? It's a decrease, for arrow pointing down, decrease in liabilities. And a decrease in liabilities, the rule says debit the account. So we debit accounts payable, creditors control. Under details we put bank, and the amount is 800. So we got a debit entry and we got a credit entry to the amount of 800. So we have had a look at 8 transactions. We've completed these transactions in T accounts. We looked at how we apply the rules, and the accounts were debited and credited, and we put in the details in each T account, the name of the contra account. So you've learned there how to record transactions in T accounts by applying the rules. But Caleb is still missing. Where can he be? Is he in the wash basket? Caleb was in the basket. Caleb has got very good at hiding away, and he's mastering this game of hide and seek. He doesn't like to lose. So Caleb, because you hid away so well, you are the winner. Yeah, that bomb, that sound effect was the bomb. Thanks everyone for watching. I hope you enjoyed the video and a tiny little bit of entertainment to go with it. And if we roll the dice, we're on course for big things. We've rolled a 6. Keep up the good work.